What's up, you guys? There is a lot of talk these days about a market crash coming in 2021. Not only in the stock market, but there's also people chirping about a housing market crash and how we've built up a bubble over the past few years. In a recent video, I discussed the stock market outlook for 2021, my thoughts on the matter, and why some experts are predicting a potential market crash, while other experts are predicting a continued bull run in the market, and also outlines some just basic advice around investment strategy moving forward throughout the year. So in this video, I'd like to dive a little bit deeper into the potential for a housing market crash, if and when that would be possible, why some experts are predicting such a thing to happen, and then more importantly, my investing strategy for this upcoming year and beyond. Before we dive in, I just want to say thank you to all those who have subscribed to my channel to this point in time. I'm truly humbled by the growth that I've seen over the past few months, and I'm looking forward to see what the future holds this year. So thank you guys so very much. In the past year, you guys have probably seen many headlines. Seems like every other week, Fed now lowers the interest rates yet again for a new all-time low. So you may be asking yourselves, what does that actually mean, and why does the Fed adjust interest rates? Now, the Fed will actually adjust interest rates periodically, both up and down. The goal of these actions is to support sustainable economic growth. Now, currently we are seeing the Fed continuously lower interest rates. When interest rates are lower, it actually encourages both consumers and businesses to both invest and borrow more, because it's now cheaper to borrow money to grow their business. Now, on the other hand, when there's too much economic growth, the Fed will actually slightly raise interest rates over a period of time with the intent of avoiding too much inflation. Now, if those interest rates are too high for too long of a period of time, what that will do is decrease drastically the amount of money borrowed and invested, which can actually cause a contraction within our economy. So how does this affect the housing market, and what have we seen in 2020 that will ultimately affect the housing market in 2021? Now, due to the coronavirus and the economic contraction, with small businesses running either at half capacity or shut down for a number of months, and larger businesses running at half capacity, consumer spending and travel and entertainment, all sorts of things that we're used to, have slowed down drastically, and we don't know when those things are actually going to come back to full effect. So what the Fed has done repeatedly is lower interest rates over the past several months with the attempt to avoid going into a prolonged recession. As I mentioned before, when they lower interest rates, they are trying to stimulate borrowing and investing, and we have certainly seen this in the housing market. Now, in particular, with so many people purchasing new homes or investors looking to lock in a really low interest rate on an investment property long term, this has increased demand for real estate dramatically. With increased demand, this has diminished the supply of housing significantly in the real estate market. When this happens, especially with first-time home buyers or investors, houses are often listed and under contract very quickly, sometimes on the same day. So with that much demand, it actually causes bidding wars, which drives up the bidding price that investors and people are willing to pay for a house. Now, as more houses are sold and then more houses are appraised, and those appraisers are looking at local comps in the area. So as local comps continue to rise and there's more houses sold, the new appraised value of those houses and the surrounding market also continue to rise. Now, with interest rates so low, it makes borrowing money so attractive, especially for home buyers. It's better for them to lock in an interest rate which honestly is probably going to be outpaced by inflation. So it's almost like borrowing free money when you look at it in that lens. All this combined has caused a dramatic increase in real estate prices across the country. And sure, this is great for people who have had their home for several years and they're seeing, their housing prices go up by 10 or 20% over the last couple years. But is this sustainable, and how is this going to play out in 2021? Now, at the beginning of the coronavirus pandemic, there was something that is known as the CARES Act. And there's a certain provision in the CARES Act that allowed any borrower that has a mortgage backed by the government servicers such as Fannie Mae and Freddie Mac can request a forbearance period of 180 days plus an additional 180-day forbearance extension. A forbearance for borrowers allows them to temporarily stop making monthly mortgage payments. More than 2.5 million Americans took advantage of this penalty-free forbearance option. In December, the Federal Housing Authority actually announced the extension of the protection against evictions and foreclosures for the forbearance period to the end of January in 2021. So you may be asking, what happens when the forbearance period ends? So borrowers that have entered forbearance have a few options that if they haven't already spoken with their lender, they probably need to get with their lender and come up with a plan or see what options they have available. And typically lenders are going to provide one of the three following options. Option number one is that every payment that was missed due to the forbearance period comes due in the form of a lump sum. Option number two is for the lender to present options for their borrowers to come up with a monthly repayment plan that's tacked on to their normal mortgage amount. Option number three is to tack on the lump sum or additional monthly payments onto the back end of the loan. Now, what many experts are fearing is that the 2.5 plus million Americans who had entered a forbearance period are going to be unable to meet the repayment program for that forbearance when the lender comes knocking at their door. Now what happens then is many people may default on their loan, causing them to go into foreclosure. Now if there's a drastic amount of foreclosures that happen, what we're going to see is a dramatic increase in supply and housing in the market, which could present some very harsh consequences for the housing market. Something to consider, which is what happened back in 2008 and 2009, is with the many Americans who went into foreclosure, they are most likely not going to be eligible, especially for an FHA loan, to apply for a new home loan for up to 3 years. So that's going to drastically reduce the demand for new houses. Now with the dramatic increase in supply and much lower demand, it's going to cause real estate prices to contract a bit. And since so many people just bought new houses at inflated prices or refinanced their houses at inflated prices, they now have a loan that is greater due to the bank than what their house is currently worth today. And that in itself can cause many more foreclosures to happen, which could cause the housing market to go in a downward spiral. Now, whether this happens in 2021 or not, honestly, I'm not sure, and I'm not one to make those bold predictions. What we do have to do is realign our investment strategies to account for the possibility of this to happen and make sure our investments are sound in the short term and the long term. I personally buy and hold properties with the intent of cash flowing and holding on to those properties for many, many years. So I personally want to ensure that we're cash flowing enough to cover us in any short-term economic fluctuations, and short-term housing prices should not affect our strategy in the long run. As long as we get in at a fair price and we're still cash flowing, I think those investments will be sound in the long run. And if we can stay cash flow positive during the beginning of the coronavirus pandemic, when everyone was essentially at stay-at-home orders on a lockdown and travel came to a complete halt, I'm very confident that we are going to continue to cash flow in future economic downturns as well. Now, as far as acquiring new properties this year, I say proceed with caution. What you don't want to do is get in a bidding war and let your emotions get the best of you and overpay for a property and lower your cash flow and total return on investment. Because if you do this and your return on investment and cash flow numbers are not strong enough, during an economic downturn, it's going to put you in a very tough position. And if you acquire a new property at an inflated value and we see a contraction in the housing market, it may take many, many years for you to get that equity back. So what I'm personally focused on for 2021 is looking for properties that need a little bit of work and we could get at a fair value or even at a discounted value, because these properties typically do not have pressure from other investors, especially when it comes to short-term rentals. Many investors are looking for properties that are furnished with rental history, that they can get their turnkey and they could list them on Airbnb the next day. So by acquiring properties that need a little bit of work and getting them at a discount, we instantly get equity from forced depreciation through any work that we do, whether it's cosmetic nature or more serious rehab, and then we're cash flow positive and we have sort of a padded protection based on that added value that we put in at the forefront. In addition to that, by doing that added work, it actually will juice up our cash flow because we have a much nicer property than what it was before, so we're likely going to have a higher cash flow and a higher cash-on-cash return than we would have if it was a turnkey property. The most recent property that we closed on in the fall was a mountain house in Gatlinburg, Tennessee, and it was a rental property before but needed quite a bit of cosmetic work. It was actually doing a revenue just north of $60,000 per year, and after the work that we did, we not only jumped the value of the house up by about $100,000, the new forecasted revenue potential for the year is $125,000. So just by waiting for the right opportunity that needed a little extra love and a little extra work, we were able to more than double the revenue potential. Another strategy that I'm really focused on right now, which honestly all of you watching can get involved in, and it takes $0 out of pocket. So the barrier to entry from a cost perspective is very low. This strategy is called co-hosting. And what co-hosting is you literally co-host a listing on Airbnb or VRBO, and you act as the property manager. So you approach an investor or a potential, current Airbnb owner or host, and you offer to take the day-to-day, management and maintenance off their hands. You control all the guest communication and scheduling with your cleaners. And what you do is actually get paid a certain percent of gross revenue every single month. So it takes $0 out of pocket, and it's an instant cash flow play. And yes, it's not completely passive, but if you set up the right systems and you have it automated to some extent, it is almost passive income. So great strategy for people looking to get into short-term rentals but maybe don't have the capital today. Now, one strategy that I may advise some people to avoid or proceed with caution at least is flipping houses. Now, you can make a tremendous amount of money flipping houses, but what you don't want to do is get caught in a really tough situation where you buy one or multiple properties with other people's money and you get the property what you feel is at a discount. You put in several thousands of dollars worth of work into the property, and if the market tanks and the buyers leave the market, and now you have a house that is worth a lot less than what you thought the after repair value would be. So that could put you in a very tough situation. So with all that being said, the housing market may contract in 2021, but on the other hand, with interest rates still so low and we don't see a dramatic increase in those interest rates in the near future, there may be a continued rise in the housing market after all throughout the next year. The only suggestion I can make to all of you watching this is to make sure your investments are sound, the numbers make sense, and you invest for the long term. Where people get in trouble is when they try to get rich quick and get over leveraged in certain situations, as I mentioned, like flipping too many houses at once. What do you guys think? I want to hear from you. Drop your comments below. Where are you investing? Are you even investing in real estate right now, or are you avoiding real estate altogether? If you're investing in the stock market or cryptocurrencies, Bitcoin's on a crazy run right now. Let me know what you guys think. I'd love to hear from you and answer some questions that you have and see what comments that you drop down below. Thank you guys so much for taking the time to watch this video, and I hope to see you guys again very soon.